Modern Real Estate Practice, page 282. Age, marital status, and receipt of public assistance. Real estate professionals should be aware of the protections offered by this law because their clients should not face discrimination when applying for a loan to buy a property or when applying to rent one. A creditor may not consider age unless the applicant is too young to legally sign a contract, which is usually 18, although the creditor may consider age if determining if income will drop due to retirement. Lenders are prohibited from discriminating against recipients of public assistance programs such as food stamps and rent subsidies. Lenders may not ask questions about a spouse unless the spouse is also applying for credit. They may not discount a woman's income or assume that she will leave the workforce to raise children. If a loan application is rejected, the Federal Fair Credit Reporting Act, FCRA, requires that the lender detail the reasons for the rejection in a statement that may be provided to the loan applicant within 30 days. The loan applicant also has the right to a free copy of any credit report that was considered in the loan application process. Additional state protections may also apply. The agency that enforces ECOA depends on the type of financial institution. The ECOA is enforced by the Federal Trade Commission, FTC, and the Department of Justice, as well as other agencies. Community Reinvestment Act of 1977, CRA. Community reinvestment refers to the responsibility of financial institutions to help meet their community's needs for low-income and moderate-income housing. Under the Community Reinvestment Act of 1977, CRA, updated in 1995 and 2005, financial institutions are expected to meet the deposit and credit needs of their communities, participate and invest in local community development and rehabilitation projects, and participate in loan programs for housing, small businesses, and small farms. Information on the Community Reinvestment Act and other programs is at www.federalreserve.gov/community DEV/CRA low-about.htm dot, or was that just period? Other programs is at www.federalreserve.gov/community DEV/CRA low whatever the fuck it is -about.htm. The law requires any federally regulated financial institution to prepare a statement containing a definition of the geographic boundaries of its community, and identification of the types of community reinvestment credit offered, such as residential housing loans, housing rehabilitation loans, small business loans, commercial loans, and consumer loans, and comments from the public about the institution's performance in meeting its community needs. Financial institutions are periodically reviewed by one of three federal financial regulatory agencies: the Comptroller of the Currency, the Federal Reserve's Board of Governors, or the Federal Deposit Insurance Corporation. The institutions must post a public notice that their community reinvestment activities are subject to federal review, and they must make the results of these reviews public. Real Estate Settlement Procedures Act. The Federal Real Estate Settlement Procedures Act, acronym RESPA, RESPA, applies to any residential real estate transaction involving a new first mortgage loan. RESPA is designed to ensure that the buyer and the seller are both fully informed of all. Page 283. Costs relating to closing the transaction. The disclosures required by TILA, TILA, and RESPA have been combined into two new disclosure forms created by the Consumer Financial Protection Bureau. These disclosures and the new forms will be discussed later. Computerized loan origination. Thanks to the use of electronic databases and telecommunications, a real estate professional can use a desktop, laptop, or tablet computer, or even a smartphone to call up a menu of mortgage lenders, interest rates, and loan terms. All of these can be done from the brokerage office, the buyer's home, or any location that provides wireless internet service. Consumers can also make use of a variety of internet sites to shop for a loan, comparing features and costs, and even apply for a loan online. In states that allow brokerage involvement in the mortgage loan process, a broker is permitted by RESPA to earn a fee of up to 1/2 point of the loan amount for providing a borrower access to a lender available through the brokerage's Computerized Loan Origination System, CLO, and assisting the borrower in completing a loan application. The borrower pays the fee, which can be financed. The borrower must also be informed that there are lenders other than those that are available on the CLO. Automated underwriting and scoring. On the lender side, new automated underwriting procedures can shorten loan approvals from weeks to minutes. Automated underwriting also tends to lower the cost of loan application and approval by reducing a lender's time spent on the approval process by as much as 60%. Freddie Mac uses a system called Loan Prospector. As of June 1st, 2015, Freddie Mac no longer charges lenders a fee, previously $20 per transaction, to use its automated underwriting service. To encourage its use, Fannie Mae has a system called Desktop Underwriter, which reduces approval time to minutes based on the borrower's credit report, a paycheck stub, and a drive-by appraisal of the property. Complex or difficult mortgages can be processed in less than 72 hours. Though automated underwriting, one of the borrower's biggest headaches in buying a home, waiting for loan approval, is eliminated. In addition, protective buyers can strengthen for loan approval is eliminated. In addition, prospective buyers can strengthen their purchase offer by including proof of loan approval. When used in automated underwriting systems, the application of credit scores has become somewhat controversial. Critics of scoring are concerned that the scores may not be accurate or fair, and in the absence of human discretion, they could result in making it more difficult for low-income and minority borrowers to obtain mortgages. Freddie Mac has the following to say about automated underwriting. Whether using traditional or automated methods, underwriters must consider all three areas of underwriting: collateral, credit reputation, and capacity. When reviewing collateral, underwriters look at house value, the down payment, and the property type. Income, debt, cash reserves, and product type are considered when underwriters are looking at capacity. Credit scores are simply one consideration when underwriters are reviewing credit reputation. Even lenders who use an automated underwriting system, such as Loan Prospector, still rely on human judgment when the scoring system indicates that the loan application is a higher risk.